Welcome to the System Simplified podcast, where we feature top leaders who share stories on how to successfully systemize a business. Now, let's get started with the show. Hello, Adi Klevit here, the host of the System Simplified podcast, where I feature top founders, entrepreneurs, and thought leaders about systematizing a business. And today's episode is being brought to you by Business Success Consulting Group, where we create, document, optimize, and implement processes and procedures so businesses can grow and thrive. And today's guest is actually a recurring guest, which is David Barnett. Hi, David.
Hey, thank you for having me back.
You are very welcome. It's great to have you back on the podcast because we had a great conversation, and I'm going to include that in the show notes, but there is so much more that we can talk about, and we are going to talk about in terms of selling and buying businesses and having the business ready for sale. And we're going to talk today about selling the transaction, but from the buyer perspective.
Okay.
So we can look at it from both angles and see, if we look from that viewpoint, what do we need to do if we are selling our business, and what is a buyer looking for? And of course, any other topic of conversations that we would like to address. So first of all, let's start with your bio. So you've been working with small and medium-sized businesses for over 20 years, and you have helped entrepreneurs buy and sell them. So you do both. You have the seller and you have the buyer perspective. So it's definitely, we want to get both angles. And you have helped them grow. You've helped people finance them. You are the author of 8 books, and you're actually writing the 9th one. So this is an evergreen. We hope this will be an evergreen episode. So anytime our listeners would like to know about buying and selling businesses, they're going to listen to it. So by that time, your 9th book might be out, maybe number 10, who knows? But right now
hopefully.
We are between 8 and 9. So that's good. And so you wrote the books about small business transactions and local investing. And you're the host of a YouTube channel, which I was a guest on. So thank you for having me on it, with hundreds of videos about buying, selling, financing, and managing small and medium-sized businesses. And you can be found anytime at your blog site, www.davidcbarnett.com. So davidcbarnett.com. Definitely a lot of blogs there, a lot of information. So David, again, welcome to the podcast.
Thank you.
Yeah.
And so do you want me to kick things off?
For sure, go for it.
So this is, I know that we're speaking to a group of business owners largely in your audience. And so this is the thing I'd like everyone to think about, is that I don't believe that anyone can be successful in business without spending some time thinking about their customers and what their customers want and what their customers need, what they'll pay for, what they value, etc. Right? And so because we spend a lot of time thinking about our customers, it allows us to innovate, create new products, bring new things to market, serve them in ways that they appreciate. And then this builds loyalty, repeat customers. It allows us to grow our businesses. It all works very well. And this is one of the things that helps make people successful. And so it is amazing that when people often try to begin the work of selling their business, they actually don't think about the person who's going to buy it. And when you decide to sell your business, what you're doing is you're boxing up your business, and if you're using a business broker or an M&A professional, for example, it's like you're boxing up your business and turning it into a piece of inventory on that broker's shelf, because they now are like the shopkeeper. They're going to try to sell that business to someone else. And we need to think about the person who's coming in the front door of their shop who wants to potentially buy your business. And we need to think about how they're going to think about your business and what they need to get out of the transaction in order for them to want to actually go forward and do the deal. And so this is what I hope to bring to the conversation here today on your show, is to help give business owners a little bit of insight into how buyers think about the opportunities that are presented to them. Because it can be very easy to believe as a business owner, especially if you have a strong, successful business, that you kind of own that golden goose, right? The goose that lays the golden eggs, and that everybody should fall over themselves to pay higher and higher prices to get your golden goose because you know how valuable it is. But from the perspective of someone who doesn't know it as well as the current owner, your golden goose could look very confusing and appear to have a lot of risks attached to it that they don't fully understand and they're afraid of. And so I often say that when buyers approach a business deal, they're typically asking two big questions. And the first question is, what is the actual demonstrable cash flow that this business is generating? And then this is going to allow them to figure out what they believe it's worth. We can talk about valuation, multiples of cash flow, all that kind of thing. But they need to figure out what the cash flow is in order to exercise any of those methods for trying to figure out a price. The second question, which is actually the more important question, is will that cash flow continue under my stewardship? And that opens the whole area of conversation when we start to talk about, well, are there customer concentration issues? Are there supplier concentration issues? Are there groups of people, whether internal or external, who have fierce loyalty to the current owner who may not want to carry on doing business in the same way with the new owner, right? And are we going to be able to figure out how to run this business, which opens the conversation to the stuff that you do, which is, are things documented properly? Do we have the procedures and systems in place so that we can show the new owner how they're going to be able to run the business? And if there are uncertainties about that second question, there's two ways that the seller can address it, or the buyer can address it. They can either push for ways to share the risk with the seller, which often means adjusted deal terms. So that might mean they're more comfortable at a lower price, or they want the seller to finance more of the deal through a seller note, or they want some of the consideration to be through an earnout, so literally based on future performance. They want to see the business actually execute at the level you claim as a seller it's going to for them. So they say, okay, great. So based on my first 3 years, we'll tie additional compensation to these criteria that we established. So adjusting the terms is one way that it can be addressed. But if the fears are just too great and the unknowns just seem too scary, of course, one of the safest moves anyone can do is simply to not do the deal and keep their
Right.
capital for the next thing. And that's what we want to try to head off when we work on preparing the business to meet that prospective buyer. We want to be prepared to understand what are the things they're going to be afraid of. How are we going to illustrate, show, demonstrate, etc., that those fears may be unfounded. But if they are founded, like if we know that 60% of revenue comes from one customer, then we need to be prepared for this to be an issue so that we can actually telegraph to the buyer immediately upon meeting them that we know this issue exists and what sort of remedies we are prepared to talk about in order to address that. To pretend it's not there and not surprised when somebody starts to talk about it can make people very worried that either you're trying to be deceptive in some way, or that just question why you're blind to this obvious risk factor that could be attached to the business.
Absolutely. Yeah, those are very good points. So you covered a lot. You covered it from the seller, like how the seller can be prepared. And that's an advice to somebody who wants to sell. But also for those listeners that are looking at buying a business, you also address it from the buyer's viewpoint. Here are the questions that you have to look at. Here are the points that you have to look at, not the questions you ask, the points you look at in terms of like, yeah, I mean, it's like, what's the diversification here in terms of customers? How is the cash flow? What are the risks? Are there any specific points that as a buyer, let's say I wanted to buy a business, that you will tell me right now, Adi, this is a non-negotiable, you have to look at those points and ask about those points?
Well, the process that I always recommend people follow when they're buying a business is to, number one, look at the information presented to them by the seller. And if the seller is represented by a business broker, then there's probably been some kind of package prepared for them that has a bunch of financial and other information put together. If there's no intermediary, then maybe the seller's just providing financial statements, tax returns, other sorts of things. But the buyer should look at that information and then make a non-binding offer, what's sometimes called a letter of intent. But the idea is that you want to make sure that you and the seller are on the same page from a business deal point of view before you bring in a bunch of attorneys and other people that are going to have high hourly expenses attached to them. So you make an offer which simply says, based on what you've shown me, this is what I'm prepared to do. This is all subject to due diligence. It's subject to my attorney's approval. It's subject to our attorneys coming up with the final paperwork that's going to be satisfactory to both parties, and that both of us still want to do the deal when we get to the end of this, negotiation due diligence period. A lot of the times, people cannot come to the initial agreement. And so we don't want to waste our time and effort and resources paying attorneys and accountants if we can't even come to the basic terms. If we can make that basic agreement, then we get into what's called the due diligence phase, where we then verify and validate everything the seller told us based on third party points of data. So this is when the buyer is actually expending effort to make sure that everything is as it's been claimed. And sometimes things are not as they've been represented. And it doesn't mean necessarily that the seller has lied or is trying to misrepresent or what have you. I've been a part of many deals where buyers have discovered errors, buyers have discovered mistakes, buyers have discovered problems in the seller's business that the seller didn't even know was there. But a lot of the times these will then affect those two first questions I mentioned. So it'll either be demonstrated that the cash flow isn't quite what we thought because of whatever reasons, or there are other issues uncovered that create even more questions with respect to whether or not the cash flow will continue. And so I often tell sellers, you may want to engage in some kind of due diligence of your own before you ever meet a buyer, just to try and make sure that some of these things that are more easily discovered are discovered by you so that they can be addressed by you. Ideally, 3 years before you sell, but we know that doesn't always happen. The 2 years before you want to meet that buyer are the two most critical years. Those are the years that are going to get the most scrutiny.
So what are
And
some of the actions that you would recommend for a prospective, I mean, we would want to talk about a buyer, but a prospective seller for those 2 years before they want to sell? What would those actions be?
yeah, so there are many people who own businesses who are trying to maximize the cash flow of the business into their own pocket. And that may lead them to make certain decisions with respect to how they manage the business. They're trying to manage taxes or trying to do different things. They may be encouraged to make certain investments, take advantage of bonus depreciation. Like there's all kinds of things that could happen. What you want to do is you want to have the most transparent books that you can in preparation for someone who's going to come and look at your business, because you are not just trying to convince the buyer that your business is sound and it produces a certain level of cash flow. You're actually going to show the buyer, convince the buyer, and you have to teach them what they need to know, because they're going to turn around in this kind of game of telephone. They're going to turn around and give the same pitch to their lender. And they're going to bring your numbers to their lender, and they're going to have to convince their lender why, your business is a good one for that lender to make a loan for in order for them to make an acquisition of your business. Now, there are plenty of people who, get into that gray zone of managing their business. They do things that are not technically okay with respect to tax rules. And then when they go to sell their business, they talk about these add backs. Well, there was a vacation I took, but I put it as a business expense. And there's my sailboat, which is not really a business thing, but I own it in my company. And when they go to sell, they start to add these things back, saying they're really part of the profit. And here's the challenge is that you may very well convince the buyer that these are absolutely accurate. And the buyer may say, yeah, I still want to buy your business. I know I don't need a sailboat. The problem, though, is in that second step. Because if that buyer can't convincingly convince their lender that the deal is good, even though your financial statements and tax returns tell a very different story, they're not going to be able to get the loan. And so what I say to a lot of business owners is that, if you are going to play fast and loose with tax rules and do things in order to try to put more money in your pocket, the cost of doing that could very well be that you move your deal from being a bankable deal to an unbankable deal. And what that means is you still can sell your business, but you are going to be the bank. And I have been
Yeah.
front row center at many deals where buyers are putting 20 to 30% down and the seller's carrying a note for the entire balance. And most business owners don't like to hear that because all of a sudden you now have to make very certain you choose the right buyer who's going to be a successful operator and be able to pay that note. But that's how you can change the dynamics of your deal based upon your behaviors. So if you want more cash at closing and you want it, if you need to hold a seller note, you want it to be for 5 or 10%, some very small amount, then you've got to have clear, transparent, easy to understand financials that don't have a lot of explanation with respect to add backs and personal expenses and this kind of thing.
Makes total sense. Now let's talk about it from the buyer's perspective. Let's say we get a deal is great or deal is good, the deal is done. Now it's theirs. The business is theirs. What do you usually see the problems that happen after the close?
Well, there's another problem that happens just before the close that can sometimes prevent closing. I'd like to get into that. And
Yeah.
that is a misunderstanding in many cases about the idea of operating capital or a normalized balance sheet. People are familiar with the idea of normalizing a P&L. I just talked about add backs. That would be adding back an expense to make a bigger profit. But what a lot of business owners don't realize too is that there's a certain balance sheet that would be the representative balance sheet for your business given your industry. And this is going to be different based on the type of industry you're in. So if you own a lumber yard building supply company, for example, you're going to have a very large inventory. Normally, a business like that would be supporting that inventory with a line of credit, for example. You may have been in business for the past 30 years and you may have been profitable. You may not have a line of credit. So your balance sheet does not look the way it normally would given your industry.
Mm.
What this can create is a little bit of confusion because sometimes the sellers don't understand that the value their business has, it's called an enterprise value. And what we normally assume is that the enterprise value includes the normal net position in working capital for that kind of business. And this can vary depending on the type of industry you're in. And it's really important. One of the big reasons why you need to work with someone who is familiar with how these things work. So the buyer, when they look at acquiring your business, their question is, how much money do I need to invest to get this cash flow? So if you have a business that has receivables, payables, inventory, a certain amount of cash for seasonal swings in activity, it can be easy to think, well, I've sold my business for a certain amount of money. The cash in the bank is mine. The receivables are mine. I already earned that money, so I get to keep that, right? Well, you may or may not be able to keep that because there might be a certain requirement for a minimum level of operating capital to transfer with the company in order to support the earnings of the company. I always say that for certain businesses, having money to finance your customers' receivables is just as important as the delivery truck. Without the delivery truck, you can't make deliveries. Without the capital to finance the receivables, you can't keep your customers happy because in your industry, everyone expects to pay in 30 or 45 days.
Yeah.
And so the buyer, if they're going to buy your business and pay the seller, and then they have to inject another $200,000 into their own new company, they combine those two numbers and they say, this is my investment. Does this investment warrant, the cash flow I'm getting? And so I've seen a lot of deals where people think they have a deal. They get into due diligence. The buyer brings in some accountants. They start to look more carefully at what the balance sheet looks like. They start to look at the operating capital needs. And then there's a second whole round of negotiation based upon what they call it an operating capital peg they're going to want to use to adjust from. And then depending on whether it's a share or an asset sale, that number is either deducted from the selling price or it's expected that the shares of the company come with certain capital within. So that can be the next big thing. The once you get it closed, if everything closes okay, then you end up in the normalization or transition period where typically the seller is sticking around for some period of time to help the buyer learn how to run the business. And depending on how you have created your systems and processes and all the checklists and things that you've worked on, that's going to determine how long the buyer expects you to stick around. And I've seen deals where the seller is sticking around for 3 weeks and then available on the telephone for the following year, for quick questions and things like that. But I've also seen deals where the seller was expected to show up every day for 2 years. It all depends.
So the difference between showing up and not showing up, what I'm hearing is if you have well-documented processes and procedures, you might not be needed as the seller to show up every day because everything will be in place, right?
Well, yes, but the other part of this can be relationships. So in the deal where the seller was tied to the business for 2 years after, it was because 80% of the revenue of the business was tied to the owner's own sales efforts. And so the buyer said, "Hey, I need you to stick around with this business so that you and I can go on some of these meetings together so that everybody gets to the point where they trust me and know me as well as they do you. And then I still might need you to come to some golf tournaments for a couple summers after that too, right? And or trade shows or what have you. So
I mean,
it
we actually did a great project of documenting the knowledge transfer for that exact reason, because the business was so dependent on the owner for building relationships, for business development, that the owner had to, we needed to do a knowledge transfer from the owner's head and create a business development structure that can be passed to someone else. So I completely can relate to that. Many times, David, we are being brought in by the buyers because they realize that now they bought a business, but the knowledge is contained in people's heads. And if those employees are going to walk out the door, the majority of the investment of what they just bought is going to walk out the door as well.
yeah,
Have you seen
yeah.
those scenarios?
I always say every business has systems. It's just where are they? Are they written down or in someone's head?
That's very true.
Yeah.
So, yeah, I agree.
So I can definitely understand. I remember when I first started helping people with these processes, I used to hear a lot of stories about documentation. And then finally, when video cameras got compact enough, I started to realize, hey, people can use these in these handover processes. And we started to get more and more people that would show up, in that transition period, and the buyer would like bring a video camera and they would like record interviews or record employees doing things physically. Like, this is how you do this on the machine or what have you. And then now, since we've moved to the fact that everybody's got a video camera in their pocket on their cell phone, it's becoming easier and easier to create these recordings and documentation of how you do certain things. And now that we have AI, I'm sure it's even faster to sort it out. You must be using some of those tools with the work that you're doing.
Well, we're definitely using the tools, and it's just a matter of, I mean, we record ourselves, we record what the client is doing, and then we use it in order to extract the information and
Mm,
make it into processes that can be followed. And to your point, it's definitely makes it easier. Like without video, without AI, it would have been much difficult. But I also see that you can start recording things, but who's going to watch those videos? So it's a matter of, like, we know that if we record an hour and a half, we have to distill it to actual steps that can be followed,
sure.
and specific like videos that are maybe a minute or 2 minutes so people can actually follow it, because otherwise it's a mess. I mean, you're not going to buy now a business and watch like 10 hours of unedited video. So definitely it is a great start, but then it has to be taken into the actual what's important, what's not. And to your point, it's not just recording what the employees are doing, because that you can say, well, okay, it's a computer software. Let's say they work on QuickBooks or they work on the ERP system, and we can get a trainer here and figure out how to do it. Where it becomes a challenge is the best practices. It's the do's and
Mm,
don'ts that internally, that that's the way it is. Like, it's why are you doing it this way? Just like the owner in your story had all those connections, you have a certain way of doing it that maybe you're not recognizing what it is, but it's your way of doing it. I mean, look at
yeah.
you, like how you deal with your clients. I mean, you are so knowledgeable. You deal with them in a certain way. You talk in a certain way. You have your own process on how you deal with your clients, another M&A broker would not have that. They would not be able to do that. And
Well,
yeah,
but further to that, here on my team, we literally have uh, 6 standardized projects, and each one goes through the same steps. And we present them as products actually rather than services. We say, well, Mr. Client or Mrs. Client, you need one of these, and this is what you get, and this is what we need, and this is what it entails, and this is what it costs. And just because so many people have the same sort of need, it's the same thing over and over. And because we've been able to formalize it into that process here with us, we've now been able to actually build some pretty cool tools that help us move through that process more quickly and more accurately for people, over and over again. Obviously, with our experience, knowing if the outputs make sense or not. But it's really changed a lot in the way we work with people. I remember, 15 years ago, it was like every person that called me up, they're like, I need your help with this. It would be like, okay, well, how am I going to help them with that? And after a while, you start to realize, hey, I'm doing the same things over and over. And that's when you realize, hey, we can really turn this into almost a production kind of thing, even though it is really a service to people.
well, and that's brilliant. That's how you productize as opposed to just service. But as you can see, you cannot ask AI, hey, write a process for my business. It's not going to happen. You have to base it upon your experience, what's important, what's not. And then you can use AI in order to compile it, to edit it, to put it in a language that you want. But you have to then look at the outcome and monitor it. So that is true for any industry. And it's also true for people that are buying and selling businesses, because truly the difference is what they put into it and how they made it into a successful business. And that's the fun part of discovering what made it so successful, or what made it what it is.
I heard the best quote I've ever heard last night. I was watching a video online, and the guy explained that if you don't give AI something to work with, the product you get is the average of all the Reddit and LinkedIn comments it's read.
That's exactly right. So it is right. And then that's, if you look at it, you go, okay, I mean, and let's use AI to figure out what's out there. Let's make it better then. And that's what you
Yeah,
do.
yeah,
It's like,
absolutely.
otherwise you're going to be, it's kind of like vanilla. It's like everybody else, but it's not. It's your business that you're selling or buying a new business, or you're making it your own. So that's where, that's where the tribal knowledge come into play, and making it definitely better and worthwhile buying, or worthwhile selling, or doing something worthwhile with it. So yes,
So, can I take your listeners through a little mental exercise that they might
please
want
do.
to apply if
Yeah,
they're thinking they might want to sell their business?
please.
So, so this is an exercise I take people through sometimes when I'm in a group setting with business owners. Is I'll ask people, who in the audience here believes their business is worth $1 million, and a bunch of hands go up in the air. And then I will explain that the average business buyer is actually an individual who's accumulated some net worth. They've got good credit, they've got home equity, some retirement savings, and they have some kind of industry experience that makes them want to buy your business. They think that they're going to be aligned with it. They're going to have some advantage in running the business. And this person is probably going to be able to bring 20 to 25% of the purchase price to the table. And then they're going to borrow the balance either from the bank or in the form of a seller note, but the rest of it's going to be debt. And so then what I do is I show, like, here, given the current interest rate, and here's a common amortization period, here is the loan, here is the payment every month that this person's going to have to make. And then I'll say, everyone with your hand in the air, how easy would it be for you to run your business today if you were going to make this payment every month on top of the obligations you already have? And then, all kinds of hands disappear. And that's the same kind of exercise that anyone can go through. Look at your P&L, look at how much money comes out to you, both in net income, a salary you might take, those perks that we talked about earlier, sort of personal expenses. Add it together, figure out what the total cash flow is that someone might enjoy if they owned your business. Figure, this is what I think it's worth, and then go through the same exercise that a buyer would go through. When you look at the total amount of cash that comes out of that business, we call that often seller's discretionary earnings. The SDE is sometimes represented as owner's profit or something of that nature. It is absolutely not profit. It is in no way meeting any accountant's definition of profit. It is, however, a budget. And it's a budget from which you have to do these things. Number one, you've got to take a salary out to support your family. So if you think that a person in your shoes should earn like $100,000 or $150,000, take that right off the top because that's what the buyer needs to take home to support their family. The next thing it has to do is pay taxes because if you've got a profitable business, you're going to have income taxes. Then you have to worry about CapEx because we often add back depreciation and amortization when we're creating these notional cash flows, but your depreciation represents real machinery and things that are expensive wearing out. And so there's got to be some kind of budget for replacing trucks, replacing machines, all this kind of thing. So that CapEx budget has to come out of the discretionary earnings as well. Oh yeah, then there's debt service. So the payment to the bank, both principal and interest, has to come out of that discretionary cash flow as well. So you have to cover all those things from the discretionary cash flow. And I've sat down with many business owners who honestly believe that their business was worth like $1 million or $2 million or something. I'll go through what we call a most probable selling price evaluation, which is one of the services we do here. And I'll show them based on data from the marketplace what their business is likely going to sell for. And I'll show them maybe that their business is worth 650 grand. And they'll say, there's no way my business is worth way more than that. And then I'll take them through this exercise. I'll say, here's the cash flow. Here's what the buyer needs to feed their family. Here's what their debt service is going to be. Here's what they need for a CapEx budget. Here's their tax bill. And we'll see, like maybe they're going to be left with 20 grand or something. Like that's all the money there is. And so when you build a business, when you're working on your business, there's this idea or belief that you work really hard, you build this thing of great value, you sell it and you cash out in some way. That's what Mark Zuckerberg does. He gets to cash out because he built Facebook. Most regular profitable businesses, they sell for a relatively low multiple of cash flow. The real juice, the real benefit in owning them is not in the exit. It's in the ownership. It's in running it year in, year out, collecting those profits, taking money out of the business, diversifying your wealth, buying other kinds of investments. So like that should be your aim. If you've achieved a certain level where you're getting good profits, if you've got your systems in place, if you've been working with Adi to get things sorted out, and you're making good money and you can start to bring in other people to take responsibilities, run that business and bring some profits out of it and fill your life with other assets. When it comes time to sell, almost every seller I know is a little bit disappointed because they work themselves up to this idea that they've got this big valuable thing. But the reality is that small businesses are risky and the buyers are always going to apply leverage. No one who has $1 million in the bank wants to buy a $1 million business. Everyone who's got $1 million in the bank is trying to buy a $5 million business. The person who buys $1 million business is a person with $250,000 in the bank. And so there's always going to be leverage applied to these deals, and that is always going to limit the value that can be paid because the business essentially has got to pay for itself. Because once the buyer takes control, the cash flow of the business has to be sufficient to pay that debt. So
That's very true and such a sound advice. David, it's been such a pleasure having you here back on the podcast. I mean, your area, your expertise, it's very obvious. I'm sure our listeners can just listen to you and go, okay, David knows what he's talking about. And the last piece of advice that you gave us is priceless. And it's very true. You have to make your business work, enjoy what you're doing, definitely build your wealth and make sure that you know when to sell and be prepared for it. So we already shared your information. Anything else that you want to share about how our listeners can get a hold of you?
sure. If a business owner out there wants to know more about the process of selling their business, I have a website called howtosellmyownbusiness.com. And I explain the different services that we do to help people do that, but there's a free download there. It's the new second edition of a book that I wrote called How to Sell My Own Business. It's a quick read. It's like 140 pages. It's got some case studies in it, and it takes you through the step by step of how the whole process will go down. and gives you a realistic view of what you're getting ready for in embarking on the process of selling your business. It also talks about, when you might want to use a broker or an M&A advisor and when you might want to do it on your own. So it kind of shows you the pros and cons of both avenues that people take.
Wonderful. We'll include it in the show notes, and I definitely encourage our audience to download it, to go to the website and download it. David, thank you so much for being a guest on this podcast.
Thanks for having me back, Addie. It's always a lot of fun.
Thanks for listening to the System Simplified podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.